Yeah, our last session, we touched a whole lot of things, and which one of them is the new name for the P&L and all that. Remember, we're treating finance. So, and we talked about more of introduction. Yes, the new name and profit and loss and all that. So, today I wouldn't go back. The records are there, so I can always go back to it. This is where we stopped last week on amortization. So today I'll go further from here, and we're starting with the profit and loss statement, which is income statement, which we did introduction last week, and I know we're going to learn a whole lot. Like I said earlier, I won't be too fast in treating finance because it's one area that most people don't have basic knowledge. Yes, most people don't have basic knowledge about finance, so I will take my time and run it. If it takes us like 5 classes, no problem, but we'll take time to get it done so that it at least will have basic knowledge about finance. Now, this is a master class, but I have to slow down, when it comes to finance. So what is profit and loss, which is currently called an income statement? Now, a profit and loss or income statement is a financial statement that shows all revenues. Please mark it all revenues, costs, all expenditure. These three things are very, very important. All revenues, all costs, all expenditure. I'll repeat myself, all revenue. It shows all revenues, all costs, all expenditure during an accounting period. Then what's the accounting period? The period that was recorded. The period it was recorded. It was done. It was done and recorded. Yeah, done and recorded. So an accounting period can be 1 week, it can be 1 day, it can be 1 hour, it can be 5 minutes, it can be 1 year, it can be a 5 years accounting period. When did we really do this? The period in which the business happened, that's the accounting period. Very, very important. Very, very important. Don't forget this. Don't forget this. So having this at the back of your mind, it is known as an income statement. Yes. Or an income or expenditure statement. Do you understand it? So please, very, very, very important. Very, very important. Learn this. Learn it very, very well. Is what shows all your revenues, cost, and expenditures. Now, currently, and most of us, especially those from the African side, there are expenses we do, we don't record them. Minor things. No. Most people, they record only the big expenses. No. I don't know whether any of us have heard of petty cash before. Petty cash. How about petty cash? Anyone here? Petty cash. Do I have anyone here? You've heard about petty cash in your place of work? What?
Good morning, sir.
Morning,
Yes,
sir.
sir. We have heard
Good.
that we have heard about petty cash.
There's another also call it impress account.
Impress account, yes.
Good. Now, the essence of petty cash account or impress account is for you to record all the small expenses. And how do we run petty cash or impress? Some do it weekly. We run weekly. Some also run monthly. Every week, instead of spending that you bought something 1,000, the other one 500, 200, having it in your main account will be a little bit distorting, bulky, entering of unnecessary things. You now bring out like 100,000, 200,000, and give to the finance department. In the finance department, they will bring out someone whose job is to make sure that this 200,000 or 100,000 that we'll do for this week, every small purchases, the person will buy it and we put it and getting the receipt. By the end of the day, by the end of the week, on Friday, the person gather all the things that we are written, all the expenses, maybe let's say 99,000. The person will now put them together with one receipt, with one voucher, now write it off. So when the auditor comes, you will see the small that made up the 99,000 and return it back as 99,000. Then another money with the 1,000 naira left, that's making the 100,000, it will be returned back as expenses. Then another 100,000 will also be given by Monday morning. That is how it's done. Yes, thank you, Sir Arinze. Beautiful. That is how petty cash or imprest account is done. So it helps you to have detail of every single 1 naira. The same thing with revenue. All the money that comes in. How do we know that all the money that comes in is recorded? By having your accounts. You remember the accounts we use. Your journals. We call them a book of original entry. Yes, books of original entry. Your purchase register is a book of original entry. Your cash receipt register, your sales register, they are all book of original entry. Your expenditure register, they are all book of original entry. Every single, whether transfer, whether cash sales, every single sales, down to 50 kobo, record it. Cash or on credit, record it. Your credit books, your debtors book, they are all books of original entry. You record all of them one after another. Remember the definition of this profit and loss or income statement. Remember the definition. A profit or loss or income statement is a financial statement that shows all revenues, costs, and expenses during an accounting period, which I mentioned. Accounting period can be 1 hour, can be 30 minutes, it can be 1 year, it can be 5 years, it can be 10 years. As long as the business transaction is going on, we call it fiscal year. Yes, FISCAL, fiscal year. Yes. Once you hear fiscal year, it means that there was a transaction within that period or physical period. That's what it means. That's what it means. Please, at any point, if you have any question, just ask. Just raise your hand. At any point you have a question, just raise your hand. Because I know we're treating finance, and I don't want to lose your questions. At any point you have any question, just raise your hand, please. Let's move on. Now, how it works. The purpose of profit and loss or income statement is to show the profitability of a business during a given period. Yes, you know, the word profitability, I know you like it. Sometimes it's also to show the loss, not all profitability or profitability, or to show even that we are still not making profit, we're not also making loss. We are still just there. Yes. Along with the cash flow statement, the balance sheet, yes, the 3 of them, it is the most important financial statement, yes, that a business produces, as it shows investors how profitable the company is. The statement usually works by showing revenues and gains, minus expenses and losses from the business activities, as well as the sales and purchases of assets. Businesses that are sole proprietorship or partnership are generally not required to submit profit and loss statements. Yes. Yes. That was then. But I speak to you now, please, everybody is to do profit and loss statement. Everybody. In fact, I will put it this way. In your house, do your own profit and loss statement as a person, as an individual. Yes. Do it for your home. How much comes into this home? How much goes out of this home? What have you been able to do with the money that have been coming in? And all and all. Do your own profit and loss statement. Your income and expenditure statement or expense statement. Do it, please. So do it for your house, do it for your home, do it for your organization. Everybody, do it. The same way you do SWOT analysis for yourself, do it for yourself as well. Very, very key. Very, very key. Very, very key. Profit and loss statements commonly illustrate the financial performance of a business over a particular month. Yes, I told you it can be a month, quarter, or year. The key piece of information are the figures for turnover or revenue. Yes, and operating profit. If profits are going to be lower than expected, the company may put out a profit warning ahead of releasing the statement. Do you understand? Especially for the companies that have shareholders, core investors. They have to see what's going to come out. When you listen to big companies, they call it they have their unaudited reports. Towards the end of year, you see unaudited report, or beginning of the year, so the unaudited report or quarterly unaudited report. We enter second quarter now. Very soon, you start hearing big companies telling you the unaudited report shows that they made a profit of this, which is like maybe 3% or 5% or 10% or 20% higher than the same time last year. That's exactly what we're saying. If it's lesser, they will also say it. Remember, it's unaudited reports. They just want to tell you that this is what we have done for the quarter. So first quarter, second quarter, third quarter, fourth quarter, and all that. Like yesterday, we sent our quarterly report yesterday. That is what it's all about. As a business, have you done your first quarter reports? Yes. Have you done your first quarter reports? The one we sent yesterday was meant for the public, which we sent out to the public. Have you done your first quarter reports financially? By this time last year, what was your profit or loss? What was your financial position vis-a-vis this year? Why? Is it going up or is it coming down? Personally, as a person, have you done your quarterly report? By this time last year, what was your profit and loss? What was your income statement? Is it positive or negative? Are you improving or not? Now, that your profit is not did not increase doesn't mean you're not doing well. Don't get me wrong there. There are some people that what you focus in the year may not be profit driven. Yes, I've seen businesses like this year, they were crazy about sales. They were very, very crazy about sales. Then next year or the next 2, 3, 4, 5 years, they were crazy about expansion. The upper year, they are crazy about ambience. Now, during the year of expansion and other things, they may not be crazy about profit driven or sales driven, which brings profit. So you can find that their profit may not be growing at the same rate it used to grow before. It's deliberate. It's not that they are losing market. They're not losing market, or they don't know what to do. But there's a focus, there's a shift. So that shift is what is guiding them. That focus is what is guiding them. So when you hear the company said, as last year, we are maybe 3% lower or 10% lower, don't get, these guys are doing bad. No. Find out what is the focus of this year. Find out what is driving the budget. What else is the focus this year? Very, very important. Very, very key. So you as a person, maybe last 3 years, you'll be making money, so much money. But you look at yourself, you've not done self-improvement, self-development. There's a number of things you've not done. You said, okay, I've made money for the past last 3 years. I've made some savings and all that. Instead of doing this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, I used to do, give me this money. I will cut out 5. That money I'm getting for this other 5 is okay for me. I'll cut out this other 5 and use the time for that 5 to focus on personal development, to re-equip myself for the next 10 to 20 years to come. Now, when you look at your revenue, your income and your income statement, it may not hit what you used to hit before, but there is something else you're doing to yourself that will make you a better person in the next 10, 20, 50 years to come. But someone by your side will say, this man, he used to make 1 billion every year. Now he's barely making up to 500 million. They will think that you're going down. But you know what you're going for. You know what you know what you're doing. You know the foundation you're laying for yourself. So let's not use numbers alone to judge an organization. Yes. I think it's Warren Buffett that said it. He doesn't just invest when things are going high. No. There are other indices he looks at before he invests. Very, very key. Very, very key. These are the things we will study in the conclave. Very, very key. So you don't wake up and judge a company because of figures. There are other parameters. That company you're judging today because of figures, hey, it's not doing well because you're not looking at the figures. They may have other things that in the next 5 years, by the time just 1 year income will cover those 2, 3 years. You think they were not doing well because of where they've moved into in other area. So have it at the back of your mind. This is very, very important. All right. This is a typical example. It's a case study. It's a typical example. I know you must have seen. I gave us asked us to go and download a report, annual report. I mean, just type it of any company. There's so many of them online. So download, you can have you have a better understanding of what we're doing now. And I said that, so I told that so most of us, this is numbers, so it'll take time. I won't be rushing it. Yeah, I won't be rushing it. So look at this. Let's just look at this as a case study. What is turnover? What is profit, operating profit? What is profit before tax? What is profit after tax? I know you're used to it, and some of us are seeing it for the first time. We just want to, these are the things you'll be seeing when you get audited, or either audited or unaudited reports. So turnover simply means amount of money taken by the business over a certain time. Yes. In this case, there was a 5.5% increase in turnover from the previous year. Do you see how it's been gauged? So in 2021, 607.5. In 2020, 575.9. So if you look at it, if you look at the two, they did well. There's an increase in turnover this 2021 over 2020. Do you understand? So they always have a comparing year, a base year to compare the other one year. So there's a 5.5% worth increase. Hope that makes sense now. Then the other year, the next one, operating profit, what is it? He said profit earned from the business core operations after expenses have been taken off, but before taxes have been deducted. So profit earned after it's taken, but before that has been deducted, it does not include money made on investments. After the back of your mind. Yes, because why we don't include it? You made investment from our profit of previous years, and that profit had been taxed. So we don't add it again to be taxed again. Do you understand? So what we're looking at that current year is the core operations, like fresh income. So the 2020, it was 221.1.7. In 2021, 234.8. So see the difference again, a positive one. Now give you the net financial expense. Do you get it? So income, expense. Move ahead. Profit before tax. All profit before tax. That's we're looking at profit, what we've gotten before the tax rate. If you look at it critically, it says profit before tax after all income and expense are being taken into account, including extraordinary payments. So after last year, the profit was 121.6. This year, 137.3. So there's an improvement. So taxes for this year, 2021, tax is 61.2. For last year, tax was what? 20.8. Someone may ask, why is tax higher this year? That's 2021. Maybe like there's an increase in tax and all that, because the figure is not different. The figure is not much for them to have 61. So like in Nigeria and all that, they have new tax law effective from January 2026. Think about it. So it can change what changes figure. Now the next one is a profit after tax. This is where you can now start spending. Now look at this critically. Levels of profit that can be paid out in dividend to the company shareholders. Do you look at this? Look at this critically. In 2020, this is how much they made. In 2021, they made more money, but look at the tax. Now, in 2020, the company had more tax, more money to enjoy. But in 2021, they did more work, more, but they have less money to pay out. Do you see the difference? So if you're looking at this company, in reality, people that were there, let's say that some people were there in 2021, and by 2021, they left. The people who were there in 2020 made more money than those that invested in 2021. Does that make sense now? So that's why I say figures are not the only thing to judge a company with, organization with. No, not only figures. There are other factors. Do you see how tax affected the profit that was what should go to the company, the shareholders? Do you see how that affected it in 2021? Tax alone. When the year was coming up, during the first quarter, second quarter, third quarter, everybody was happy. We are doing well. So those that were there in 2020 will say, okay, last year, which was 108 billion profit we shared after tax. This year, we may be looking at 1.50 or 150 billion, only for it to go down to 76. Does that make sense now? Does that make sense? So when you're studying financials, there are factors to look at for. And somebody will now say, this company did not do well this year. Last year, their profit after tax was what? 100 billion. This year, they are doing 76. Does that mean they did not work hard? Somebody will just look at just only profit after tax and judge them without looking at other factors. Do you understand? Now, the question is, what can we do to reduce our tax burden? What are the things we can do to make sure our tax doesn't go high again? These are the things they should have asked and start solving prior to this time. Yes. So learn it. Learn it. This is what expenses look like. Typical expenses. I mean, this one is self-explanatory. These are normal expenses you incur. So you can go through it at your time. These are operating costs. So from what I told you before, go with employee costs and all that. I think let's stop here. Let's stop it here. Let's stop it here. So next class we'll continue from from here. Total expense and what expense to like that. I won't rush it. I won't rush it. So there are factors to look out for. Somebody may now look at the company. Okay, what's their turnover like? I said the year before. They say this last year they did 575. This year they are doing 607. The person will say, what a beautiful company. Some people will just focus on operating profit and income before tax. Last year it was 121. This year it was it is a 137. I mean, these guys are doing well. Only for him to now go home and be waiting for them to pay high dividend. Only for him to get a lesser dividend. You're like, what happened? Without looking at the tax factor. So you need to know all the factors. You need to know all the factors. We need to know all the factors. We need to know all the factors. I will stop here. The floor is open for us, please. Let me hear your questions, your contributions. Next week, we'll move on to the next one. We'll take it one step at a time. We'll not rush it. We'll not rush it. But one thing I want you to do for us is share the WhatsApp platform to your friends. Let them come and gain this knowledge. For now, it's for free. For now, it's for free. Share it. Let them come and gain this knowledge. For now, it's for free. Your contributions, your take-homes, can we share that, please? The floor is open. We don't have all the time. I hope we know. We'll have less than 7 minutes to do this. The floor is open, please. You're welcome, Madam Joy. Go ahead.
Good morning, everybody. Good morning, sir.
Good morning, ma.
My take home on this is where you talked about Impress. You know, I never knew you can actually do Impress on yourself, even in your family expenses.
Yes, ma'am.
And I'm taking that home, you know, doing Impress on every, you know, penny that I spend. At least that will give me an idea of even how much I spend in the family, you know, managing the family, because my family is also a branch of my business.
Sure.
You know, and most times, you know, we do careless expenses without actually knowing how it affects us. You know, so that's just my take home on this. You know, giving account of every penny that is spent. Thank you so much, sir.
Thank you, ma. Thank you, ma. Thank you, ma. Wow. Wow. I love this. I love this. I love this. That's a beautiful one. That's a beautiful one. Wow. Wow. It's a beautiful one. Thank you so much. Thank you so much. All right. Some other person. What's your take home? What's your question? What's the contribution? I know his figures. Please, I know his figures. Once we get to figure, people don't usually ask questions. Those ones will be asking me after the class. Please ask it now. I don't want behind the scene discussion again. Let's discuss it here. Let's discuss it here. Please. That's why it's a master class. I don't want behind the scene. Let's discuss it now, please. Please. Okay. Take home, please. Your take home. Who is taking? Who is next person, please?
Okay. Thank you. My own take home is the fact that when you start a business, you shouldn't look at the profit first. You should definitely there will be losses, but that is not where you stop. You have to continue pushing, because I have seen a business that have started for even up to 5 years, and they keep declaring losses, and they just had one major breakthrough in a deal that, shift from that to looking like they have made a profit for 10 years.
Wow.
And when you were discussing that, what came to my mind is this theory, organizational cycle theory, that tells you the stages of businesses, the startup stage to maturity to growth, and then debt.
Beautiful.
So that is my own take home from my own end here, sir. Thank you, sir.
Wow. Thank you, Dr. Thomas. Dr. Thomas is joining us from Australia. Thank you so much. Thank you so much.
Thank you, sir.
Thank you so much. Businesses and profits, please. Yes, profit is fine. Profit is beautiful. I mean, that's wonderful. That's the goal of every businessman. I want to see how we progress. But progress is not always measured by profit alone. Love that take home. Wonderful take homes from Madam Joy, from Dr. Thomas. Wonderful take homes. It's not only measured, progress is not only measured by profit alone. There are big businesses today. If I tell you that they're not making profit, you will shout. But these guys are global brands. They're not making profits. 5 years, 10 years. They're not making. It's not that they refuse to declare. They are not making it. They're not making profits. But they kept building. They kept building. They kept building. Yes. They kept building. So profit is not only a stick to know the growth of a business. That's simple truth. Thank you so much. Thank you so much. Thank you. Do I have one more person? One more person, and we'll call it a day. One more person. One more person. One more person. Person. Mr. Christian. Okay, what do you have for us? Okay. Okay, yeah, somebody's writing. Okay, how would they survive without profit? Okay, yes. Okay, Oga Rins is asking, how can a business survive without profit? Yes, something we said earlier. Okay, Dr. T, you want to answer that one?
Yes, I wanted to quickly say something. Sorry.
Okay, yeah, go ahead. You have 10 seconds.
Yes, the truth is that before you start up any business, there is always startup capital. And you also have arrangement for what you call recurrent expenditure.
Yeah.
And in some developed countries, government always give you a startup seed because they know that for the first 1 year, 2 years, you will declare losses. There's a possibility of you not making profit. That is why it's always good to start small, and then grow from there. So with that, you can survive without profit.
Beautiful.
Thank you.
Beautiful. And I want to just add, if you start small, like you said, and use the process of bootstrapping, you're already working. You're working. You're not leaving your job, or you start a business by the side. 5 years, you're not making any money, but that business is still running. So your mind is not to make profit, is to structure the business to stand very well for the next 100 years. So in the first 5 years, you're only working on the system, structures, getting the business, making all your mistakes. Then maybe after 5 or 7 or 8 or 10 years, business will explode. So we'll teach more of that maybe subsequent time. On this note, I want to say thank you to everyone. Let's meet again, 5 a.m. Nigerian time, next Friday, by God's grace. We'll meet again and we'll learn more. Thank you. God bless you.
Thank you so much, sir. Bye.
Thank you, sir.
Thank you, sir. Thank you. Thank you, everyone.